I'll talk about the global economy, but also talk about India. Basically, try to draw some linkages to India. If you look at this chart, this is the GDP growth of the world economy as a whole for the last couple of years. And focus on the two dark lines towards the end. You see there's some upward movement in global growth. And this is 2017, which just went by, was the first year after Lehman crisis that the global economy grew in a synchronized manner. Of all the countries, more than 120 countries are positively growing. Now, having said that, obviously I think the forecast from all weather forecasters or economic forecasters, as you would like to call them, is that it's going to be bright sunshine for 2018 and 2019. But along with the bright sunshine, there is also a forecast of very strong winds, protectionist winds, which we are already seeing. The United States levied trade tariffs on steel, aluminum, and I think if this is what is in the news, but if you scan through what has been happening since the global financial crisis, I think incrementally almost all advanced countries have been following, and also some developing countries have been following protectionism. So clearly, this is a time when I think it's a mixed blessing. There is an upsurge in the global economy, the kind of upsurge which we haven't seen before. The good news is the advanced countries which were trailing are now leading the world growth at this juncture, particularly the United States and the Europe. And within Europe, it's not the core, which is France, Germany, etc. It's also the periphery. I mean, the peripheral countries, the weak countries are also growing pretty fast. So more balanced, more synchronized, and also I think not only across geographies but also across sectors. So this growth, the defining part of this growth is that it's not only led by consumption, but it's also led by investment and also led by trade. I think that's happening at the global level, despite all the rhetoric, etc. So I think the point I wanted to make was it is good news at this juncture. This is a snapshot of a few economies and how they are likely to grow. US is expected to grow at 2.8%. And this growth has been revised up only recently, and reason is the tax cuts or the tax policy that has been cleared. That's going to create a temporary and a transitory push to growth. Eurozone is also doing extremely well, as I said. Japan, despite weak growth, at least it's not falling back into recession. And I think overall the world economy right now is in a good shape. So at least for the year 2018 and 2019, the good story is going to continue. After that, the growth will slow down. I think that is the general prediction. And reason is whether it is United States or it is Europe, it's growing above its potential. The potential rate of growth for US is estimated at around 1.6, 1.7%, and it's growing at 2.8%. So when economies grow above their potential, the central banks become a little more cautious and they start fearing inflation and they start tightening the monetary policy, and that slows the economy down. So these countries will return to their potential as forecast today by 2020 or so, provided there's no crisis in between. So that's the state of the major countries. And if I look at next 5 years, the growth is going to come largely from Asia. I think Asia continues to be the fastest growing part of the world. China and India, I think they're large. They are I think among the top 3 big economies. I think China and India figure. So I think they are located in the emerging market space, and they are leading the growth. The world economy is expected to grow at 3.7%, and I think as you move down, you find advanced economies. The expected growth is around 1.8%. So right now they are growing above the potential, but they'll soon slide back to the potential. The other interesting thing, I was talking about the protectionist winds, and many people in India fear. We have also done our own bit on protectionism. I think what's interesting in this chart is If you look at the first part, the black line that you see is the growth in world trade, and the red line that you see is growth in world GDP. So from 2002 to 2008, the world trade was growing 2 times as fast as the world GDP, which means the trade intensity of growth was increasing. So trade was on a very high at that time. And if you look at India's exports during that time, India's exports were growing at 24% in dollar terms, which has never happened before. The reason was an exceptional surge in global trade. After that Lehman crisis came, obviously countries, the trade was hit very hard, and then we saw a V-shaped recovery. But what happened after 2012 is also very, very interesting. What we saw was the world trade started growing slower than the world GDP. So the trade intensity of global growth started coming down. And this continued for 4 to 5 years. And now I think what's happening since 2017 is that the trade has suddenly started surging ahead, despite the fact that the global growth has slowed, despite the fact that there is protectionist rhetoric which is becoming louder and louder. And the reason why trade is picking up is because, as I said, the recovery is more broad-based. Investment and consumption both are firing growth. The high growth in North America means more demand for products from Asia. They can't very quickly substitute for those products by domestic production. And Europe growth also means very high. I think this next slide is about how India connects with the rest of the world. And there are 2 ways to look at it. Again, the red lines that you see on the top are India's GDP growth, and there's a straight line running through the cycle, which is the trend or the potential rate of growth. And in India's case, we all know that the trend rate of growth has only been going up. And for advanced countries, which are down below, marked in black, the trend rate of growth has been coming down. Reason is not very difficult to understand. I think these economies have demographic pressures. They are aging, so their potential itself is sliding down. Now, the interesting part is that if you look at the economic cycles, whenever the advanced countries were growing above their potential, that was a period from 2004 to 2008. Then again, I think for a brief period from 2013 to 2014, somewhere around that. And now, currently, 2017-18, whenever the advanced countries grew above their potential, India also has grown above its potential. You can map it very closely. This shows the interlinkage between India and advanced countries, and maybe rest of the world. I mean, the chart won't look very different. Now, the point I want to make is that for the last 18 to 19 years, there has been almost perfect synchronization in the growth cycles of India and advanced country. 2017 was the only year, or the first year, where this synchronization broke down. The India grew below its potential at 6.6%, when the world economy was growing above its potential. Advanced countries were growing much faster than their potential rate of growth. If I ask you why this happened, I think anybody can answer that. I mean, we had some domestic disruptions which pulled us down, and which also did not allow us to take advantage of the global growth. One disruption was demonetization, which brought our growth down. And the second was GST, which actually hit the exporters, and exporters are still trying to come out of it. And exporters were not able to export the way they would have, given the increase in demand. I think there are many issues with trade, but at least on a short-term basis, this was a key issue that hit us. Now, if I look ahead, let's say into 2018, the world economy, as I said, is looking stronger in 2018. What does it mean for India? And my presumption would be, and this is our forecast as well, that the economic growth will pick up to 7.5% next year from 6.6% this year, for several reasons. One is a very weak base, that you have grown below the potential, so you will jump up closer to the potential. The second is the assumption that is baked into it is that we'll have a normal monsoon next year, and all indications are that we'll have a normal monsoon. It's an El Nino year, it's predicted to be an El Nino year, which means sufficient rains. The more important reason is that the demonetization part is at least gone. I mean, so there's no shock. So that shock is evaporating fast. And on top of that, the GST government has understood that this GST in this form is not going to work. So they have taken steps to simplify it, and many of the problems are getting addressed. Many of them are still lingering. So to cut the long story short, the exporters who were suffering credit crunch or the liquidity crunch in 2017 will face less of that in 2018, and maybe better take advantage of the global recovery that's happening. So some push will take place from the export side. So I think that's our outlook, and that's how we see it. But our exports will not grow as fast as other Asian markets, because which exports are growing in Asian countries? It's the electronics. This is what we import so much right now, and we are not in that market. And I think so strategically, I think we have to move towards items for which there is demand. And if you look at what we export, within that we are losing competitiveness in textiles, etc. I think Bangladesh and Vietnam are giving us a tough run there. Actually, Bangladesh exports 2 to 3 times more ready-made garments than India does at this juncture. The code is that red is bad, yellow is in between, green is good. If you look at the chart, the upper part has some greens, which is, as far as growth is concerned, it slid in 2017, but we expect it to inch up. As far as inflation is concerned, I think we've been in the green zone for quite some time, helped by oil as well. The current account deficit is in the green but turning yellow, and I think we have to revise. We are in the process of revising these numbers. Looks like the current account deficit will go up to 2.5% in 2018-19, which is just the border of being safe. And fiscally, on fiscal account there is concern. If I look at what the bond markets are reading, they are reading a fiscal slippage. They are because the yields have gone up by at least 100 basis points for 10-year, which means that they are expecting more government borrowings. The government is not planning for more borrowings, but the market is expecting that. So there is some fear on the fiscal front. I think if you keep going down, I think things become a little murkier. And two things which are particularly murky and have remained murky in the last 5 to 6 years. One is the investment cycle is weakening. Investments as a percentage of GDP have been coming down. Only very recently they have started inching up, but we cannot say that it's in the green zone, because the private sector contribution to this investment is very weak. And non-performing assets, I think that's the story that is playing out on a regular basis. The muck is coming out on the table, and I think now the job is to clean it. So it's a mixed picture that comes out for India. Now, from the corporate side, I think this is an interesting slide. The top line of corporates used to grow at 20%, 16%, 18% in 2011-12, but those were the years when inflation also was very high. It was around 10%. So the real growth was not so much. If inflation is high, obviously the top line will grow faster. I think what the corporate sector suffered was from 2012-13 to 2016-17, when the top line was not even growing as fast as inflation. And only in 2017-18 there is a push up to the top line, and in FY 18-19 we expect the top line to grow at around 10 to 11% after a very long time. So that is consistent with GDP growth also moving up. This is a quick chart to I think to summarize what I have just said. I'm looking at, because everybody is so concerned about one key parameter, which is growth. So if I look at why growth is where it is, I think this chart kind of makes it clear. So what drives growth? It can be government policy, which is the fiscal policy where government spends. It could be monetary policy where central bank cuts rate. So central bank's ability to cut rates is now evaporated. They have already cut rates in 2016-17, whatever they thought was appropriate. Now I think they are in the zone where I think it's neutral. I think the chances of cutting rates are very low. So monetary policy has not pushed growth up for obvious reasons. They have inflation concern. As far as fiscal policy is concerned, fiscal policy, there has no bandwidth to spend. Government doesn't have, they have to cut their deficit even more. Now, coming to the investment cycle, well, sometimes people ask us if government is saying they're doing X, Y, Z, why is the private corporate investment not picking up? And reason is not difficult to understand. So they have made it slightly easier for one to invest if one wants to, but the other business factors are not favorable. There are underutilized capacities, and infrastructure companies still have high leverage. So there is deleveraging going on. Companies are focused on improving their capital structure, which improves their credit ratings but doesn't increase investments in the economy. Global factors I just mentioned, I think it's a mixed blessing. Oil prices going up while the export destinations are growing, and also the trade is growing, which is a good news. But I think one thing is offsetting the other, and banking sector is in the red. So clearly, some things did improve in this last 4 years, but the point was last year's developments of demonetization and GST actually did not allow us to take advantage of that. That's why growth slid. This year, I think those are fading, so growth will go up, and it will be supported by the global economy as well. So that's the story, and now let's come to risks. I think here we have domestic as well as global, but let's focus on the global side. Quantitative easing unwinding. Now, if you ever climb up a hill, it's an arduous journey. It's difficult to climb up, but the risk of slipping is much less. But when you climb down, the gravity is on your side, but you can slip. So QE is something like that. I mean, they have increased their balance sheets to a massive level. Now shrinking that balance sheet is a challenge because this is unprecedented. It's uncharted water. It wasn't known. So now Europe, Japan, they are going to follow easy policies because their recovery is still young. US is going to follow more aggressive. So rate diversion difference between US and Europe means that there will be capital flows. This is what should happen fundamentally. And if there are capital flows volatility, then I think India also gets caught in that. Second is protectionism. I think this is turning the clock backwards. Until now, countries were opening up. Now they are talking of closing down. And I think interestingly, the protectionism will not help. I mean, the many of the solutions that or problems that the world faces require global solutions. And with protectionism and nationalistic policies, I think it will be very hard to deal with them. I'm talking of problems like ecological problems, etc. Then I think geopolitical, we keep hearing about North Korea, etc. But I think all these problems are humming in the background. And the other problem which is making a little bit more noise is from the technology front. But what is happening right now is unprecedented. The artificial intelligence, which is cognitive ability of machines, I think that's increasing at a phenomenal pace. They'll start thinking like humans maybe in 40, 50 years, that's the prediction. Second, there's huge explosion as far as the data is concerned, not only in the information coming in, the volume, but also its velocity, the speed with which it is coming. So these are all non-linear developments which human brains can't fathom. I mean, we only fathom linear developments. Technology speed improves, doubles every 18 to 16 months. So this is going to create a massive disruption. Hard to predict when exactly it's going to happen, but this disruption is 100% going to play out. The protectionism, to what extent it will play out, I can't say, but there is now there is belief that the technology is going to hugely disrupt. In United States, the surgeries, even in India, I think to some extent, surgeries are getting increasingly performed by robots. And for 40% of the surgeries in US, robot is far more effective, far more accurate than a human being. So already at an increasing speed, even doctors are getting, so you have to trust your brain more to a robot for a brain surgery than a human being. So I think it's just that this disruption is happening and one needs to be cognizant of that and be prepared for that. But this disruption is going to be a big one. I mean, bigger than anything else that we are talking about.